Okay, hi there. Jeff here with another video on the UK economy. We spent a few minutes last time looking at consumer spending and saving. Let's focus, if it's okay with you, for just a little while on another key component of demand, and that is investment. Well, if consumer spending is the biggest component of demand, remember consumer spending was about 63% of GDP, investment spending, I in C plus I plus G plus X minus M, investment spending is the most volatile, unpredictable, fluctuating component of AD. In 2021, investment, including, by the way, government investment, totaled £383 billion in real terms, set against a GDP of just under 2.2 trillion. So investment, if we do the maths, was only about 17% of GDP, 17.4% to one decimal place. As we'll see, that's quite a low figure. Important to have good examples of investment, capital spending, capital goods that are used to make other consumer goods and services, so robotics in car making, integrated plants in renewable energy, in beer making, tools and equipment used in factories, critical infrastructure including energy, power supplies, telecoms, water and sewage and so forth. Software also counted now as investment that runs the hardware, and things like logistics, the lorries, the container ships, the aircraft and things that move goods and services around the economy. Always good example to have some good idea to have good examples of investment for application. And then if we look at what's happened to investment in the UK, again, investment is cyclical. It fell in the last recession from 2008 onwards. This is quarterly investment. You have to multiply by 4 to get the annual figure. Then quite a strong rise from about 2013 onwards. Investment picked up quite sharply. But then we see the impact of the pandemic. A lot of investment plans from businesses were cancelled or postponed or reduced in scale. Investments picked up a little bit and is starting to pick up again in 2022. But again, it's not much further ahead from where it was in 2019. So what are the key factors affecting investment? Again, important to have in your revision notes some underlying factors that are important. I think the biggest single driver of investment is demand. Both actual demand, what do you need to produce now to meet today's spending, but also crucially expected demand for goods and services. If you're a telecoms service, for a telecoms business, for example, what kind of capacity will you need on your servers? If you're an internet business, if you're a video streaming business, again, what investment do you need to do? If you're a car maker, when and where will you invest in machinery and factories and technology? So you can link here the expected growth of demand to the accelerator effect, which argues that planned investment is often quite sensitive to the expected growth of demand going forward. Of course, investment involves looking ahead, doesn't it? Businesses thinking, what do we need to have in place to meet demand at some future point in time? And that itself is obviously uncertain. Other factors affecting investment include the expected profits, the rate of return on capital, but crucially the taxes you might have to pay. The main one, of course, being corporation tax, which is going up in the next few years in the UK economy. Investment also linked to interest rates, the cost of borrowing money. Can you get a loan from a bank? What will it cost you? If you issue a corporate bond, what's the yield on that bond? So the cost and availability of finance is critical. And so too, business confidence, Keynesian animal spirits, that sense of optimism or pessimism about the future, which dictates whether you actually go ahead with a planned investment project. And let's not forget, a sizable, not insignificant percentage of investment comes from the government sector. So their plans for infrastructure spending also really quite important in the wider scheme of things, including things like Crossrail 2 and other projects. Why is investment important? Oftentimes in an exam, you have to examine and assess the significance of investment for the UK. And that can be both from domestic sources or perhaps from inward foreign direct investment. Well, fundamentally, of course, investment improves productivity. If workers have newer, more advanced, up-to-date machinery, over time their productivity should be higher. And our low productivity growth is in part linked to a low rate of gross capital investment. Investment can also create jobs. Somebody has to build and manufacture the technology. Somebody has to build the factories. Somebody has to design the infrastructure. The software that goes with hardware. Infrastructure projects are often quite labour intensive. They create jobs. So yes, whilst investment can replace labour, we call that capital labour substitution or automation. Investment, even robotics, can actually create as many jobs as it replaces. I think a key point in your revision is to link investment to external trade. So businesses need investment to remain internationally cost and price competitive. Because don't forget, other countries and businesses in other nations will be investing at the same time. Investment, although it's a component of demand, also affects long and aggregate supply. So higher investment can help to control inflation. You see, it creates the additional supply, which then helps to keep prices low. And we obviously be familiar at the moment with lots of supply shortages and things in the economy. Can investment help alleviate that? Fundamentally, investment stimulates the economy and can increase growth, in particular by shifting out long and aggregate supply, and again link investment to environmental objectives as we move hopefully towards a low carbon or net zero carbon economy. So investment in e-vehicles, investment in charging stations, capital investment in green energy capacity from solar, from wind, onshore, offshore and offshore wind turbine and tidal renewables. Really important to link investment to sustainability. I said that I'd just make a little comment about investment in the UK. I went to the World Bank database and just looked at the investment levels as a share of GDP, albeit in 2020, which we knew was an unusual year because of the pandemic. But I think this data won't have changed dramatically. So it will be good for revision, I think. Look at the variations there. So China, as it has done for many, many years, investing huge amounts as a share of GDP, well above 40%. South Korea, 33%. Vietnam, 27%. Bangladesh, 31%. Whereas the UK, down at 17%, and Greece down at 15%. And by the way, that's an increase. Greece was as low as 10% a few years ago. Countries such as the UK and Greece are investing far less as a share of their GDP than quite a few other competitor countries, including Germany, the United States, South Korea, and so on. Yes, the quality of investment can matter as much as the quantity, but there does appear to be an investment gap in the UK, which needs to be addressed. And this chart just basically tracks those countries: China, Bangladesh, Korea, Vietnam, UK and Greece, and you can see the UK and Greece languishing down there towards the bottom, and China's position, really preeminent position as the world's biggest economy, according to PPP, with a huge investment ratio. There we go. Investment, key topic if you want to understand growth and cycles and supply side economics. Have some good notes on investment, and hopefully this video has helped you. And if it has, maybe give it a like. That'd be really appreciated. Either way, stay happy, stay positive, and see you again soon.